Welcome, Howard and Michael.
My parents lived through the Depression. So when I grew up, I heard things like, don't put all your eggs in one basket and save for a rainy day and so forth. And he didn't hear that. So we have a different mindset. He's very optimistic, and he's a dreamer and a futurist and likes to think a great deal about the future. And I'm more like Albert Einstein, who said, I don't think about the future, it'll come soon enough. We had a chance to discuss many things, ranging from mostly the main topic, which I wrote up in my memo, Something of Value, in January 21. The main thing was value investing. What is value investing? And, where we got to was that value investing, which is putting a great emphasis on the current price accorded to the cash flows and the assets, is a good thing. It's not better or worse than growth investing, which is paying most of your attention to what the distant future holds in terms of profits. But they're both valuable, but the division between the two should not be so firm. A lot of people say, I do this, I don't do that. Warren Buffett, who is the king of value investing, his investment in Apple was probably his second best after Geico. And if he can open his mind to it, why shouldn't everybody else? So I think what the memo was about more than anything else was open-mindedness and flexibility and adaptability. And, all my life, I've made a lot of money doing the things that other people wouldn't do. 1978 is when I started as a money manager. I moved over from equity research to managing a portfolio, and I was first asked to do high-yield bonds. Most people said, oh, we don't do that. 95% of investing organizations had a rule against investing in non-investment grade bonds. Well, if everybody says we don't do that, then those things are going to be bargains. They're going to be cheap because there's no interest in them. Often people say buy or sell, in or out, risk on, risk off. I don't find those statements helpful. What I think is that every investor should have a sense for his or her normal risk position. It depends, if you're an individual, it depends on your age, your wealth, your income, the ratio of your income to your needs, the number of dependents, how close you are to retirement, what your aspirations are, and importantly, your ability to live with volatility, intestinal ability. So everybody in this audience, every organization, every person should have an idea what their appropriate risk position is. Having done so, they should ask themselves a question. Will I vary my risk posture based on what's going on in the world, and specifically in the markets? And if the answer is yes, I will, then the third question is, what about today? What should the mix be normally between aggressiveness and defensiveness? And what should it be today? When the market is high in its cycle, by definition, most assets have appreciated, and prospective returns are low. That's a time to overemphasize defense. Of course, that's not what most people do. Most people, when things go well and the economy does well and corporations do well and the market does well, they get more and more excited and they buy more and more at high prices. That's what makes tops. That's what makes bubbles. Eventually, market turns down, the economy turns down, the companies start doing less well, security now falling, and the lower they get, the more depressed people get, and the more they sell. That's what makes bottoms. That's what makes crashes. So human nature causes us to buy more at the high prices and sell more at the low prices, which of course is the opposite of what we should do. We know intellectually that we should sell more at the high prices, put on more defense, buy more at the low prices, put on more aggressiveness. A friend of mine in England wrote a book entitled Simple But Not Easy. And that's what that is. From 09 through 19, We went through the longest economic recovery and the longest bull market in history, over 10 years. And the higher things went, I think the more defense was called for. Then, of course, we had the pandemic, which nobody could predict. That brought prices very low. Then we had the Fed rescue. That brought them back up, and more so. Now, and of course, when they were high, it was important to be cautious. Now, I think personally that we're in the middle ground, Michael. You know, most people say, is the market overvalued or undervalued? Over, under. You can't be that precise. Wow. So what I say is rich, cheap, fair. Most of the time, the market is in the fair territory. There's nothing brilliant to do. And in one of my books, I wrote that if there's nothing clever to do, then the mistake is trying to be clever. I think we're in that territory now. I think that most assets are priced appropriately relative to the level of interest rates. I don't see any assets that are that cheap relative to other assets. And especially, I think that the excesses have largely been driven out. What do I mean? Let's go back a year and a half to early 21. SPACs are booming. Meme stocks are going up without reason. You know, everybody and his brother is trying to get into venture capital and crypto. But I think that there were excesses at the time. So I don't see anything that stands out to me as terribly overpriced or terribly underpriced.
Got it.
But I do think that this is a time to move forward. And today you don't need so much caution because things have cheapened so much. So everything is in line in terms of risk return, but the whole line has shifted up. When the Fed raised rates, the risk return line shifts up. And for example, a year ago, high yield bonds yielded in the 3s, and they really couldn't do the investor much good at 3%. 3% yield is not something to grab onto. But today, the Fed having raised rates substantially, now high yield bonds yield 8 or 9%. That's a very substantial yield. And that's what I call a useful yield. So I think today it's more important to be in the market. And one of the ways I like to think about things is I try to figure out what is the mistake that's out there for the making today and not make it. Today, I think not being in the market is a mistake, especially the credit markets.